Unit 3. Ownership of real property. Summary. In California, the terms real estate and real property are synonymous. The highest form of ownership in real property is the estate in fee simple absolute. It is also possible to own a life estate to enjoy property for a time measured by one's own or another's life. A reversion or remainder is the right to possess the property after the death of the holder of the life estate. A fee simple subject to a power of termination or condition subsequent may be lost on breach of a limitation or restriction. A conveyance of real estate takes place by a grant from the grantor, owner, to the grantee. Property owned by only one individual is separate property. Both real property and personal property can be separate property. Property acquired during marriage or by a registered domestic partner by gift, inheritance, or with the income or proceeds of separate property is separate property unless commingled. Most other property acquired by a spouse or registered domestic partner is community property. Two or more persons may have concurrent ownership of real estate as tenants in common, joint tenants with the right of survivorship, or tenants in partnership. Tenants in common share unity of possession, which means that each tenant has the right to use the entire property. Joint tenants share the four unities of time, title, interest, and possession. A partition action can be brought by a co-tenant who wants to have the entire property divided or sold. California_E_principles_10E_book.imp 75 the 23rd of May 2017 2:26 and 8 seconds p.m. 76 California Real Estate Principles 10th edition. A general partnership can own property as a tenancy and partnership. All general partners have the right to use partnership property for partnership purposes. All general partners are liable for partnership debts, and all share partnership income. In a sole proprietorship, the sole proprietor may take property in her own name or under the business's trade name. A corporation, whether chartered in or out of California, may own property even if the corporation is non-profit. A trust enables a trustee to hold property conveyed by a truster, property owner. For the beneficiary of the trust, a testamentary trust is established by will. A living trust, inter vivos trust, can be used to convey property on death without the difficulty and expense of probate. A real estate syndicate comprises a group of investors, generally organized as a limited partnership. The limited partners can benefit from the greater bargaining power of the syndicate while avoiding the liabilities of general partners. A limited partnership must comply with state law to protect the limited partners. A limited liability company offers the tax benefit of a partnership with the opportunity to take an active role in running the company. Open for discussion. After gradually increasing over many years, home ownership in the United States has decreased slightly in the last decade. 1. Should home ownership be encouraged as a matter of government policy? Why or why not? California_E_principles_10E_book.imp 76 the 23rd of May 2017 2:26 and 8 seconds p.m. Unit 3. Ownership of real property 77. Review questions 1. A fee simple estate and a life estate are A. Freehold Estates. B. Fee simple estates. C. Leasehold Estates. D. Estates of tenancy. 2. The highest form of ownership is A. The life estate. B. The real estate syndicate. C. The fee simple absolute. D. The estate at will. 3. Victor and Karen are not married but together own community property because they are A. Brother and sister. B. Joint tenants. C. Registered domestic partners. D. Holders of a life estate. 4. A fee simple estate that may be lost when some act is performed is A. A life estate. B. A fee simple absolute. C. A remainder. D. A fee simple on condition subsequent. 5. A fee simple estate that has no conditions is A. A life estate. B. A remainder. C. A fee simple on condition subsequent. D. A fee simple absolute. 6. If Greenacre is deeded by Lute to Mary for Mary's life, Mary has A. A life estate. B. An estate in remainder. C. An estate in reversion. D. No interest. 7. If Greenacre is deeded by Lute to Mary for Mary's life, Lieu has A life estate. B. An estate in remainder. C. An estate in reversion. D. No interest. 8. When Aunt Winifred died, she left a life estate in Whitaker to her nephew George. When George dies, Whitaker will go to George's daughter Elizabeth. Elizabeth is A reversioner. B. A remainderman. C. A holder of a life estate. D. A joint tenant with right of survivorship. 9. If Greenacre is deeded by Lew to Mary for the life of Nancy, Nancy has A life estate. B. An estate in remainder. C. An estate in reversion. D. No interest. 10. The owner of a life estate can A. Sell only the life estate. B. Never will the life estate. C. Sell the fee simple estate. D. Sell both the life estate and the fee simple estate. 11. Joint tenants have unity of A. Interest but not possession. B. Title but not interest. C. Possession and title only. D. Time, title, interest, and possession. 12. Jessica and John own Blackacre as joint tenants. Jessica's will specifies that on her death, her interest in Blackacre is to go to her sister Mona. When Jessica dies, A. Mona will be a tenant in common of Blackacre with John. B. Mona will be a joint tenant of Blackacre with John. C. John will be sole owner of Blackacre. D. The probate court will have to sell Blackacre and distribute the proceeds to John and Mona. California_E_principles_10E_book.imp 77 the 23rd of May 2017 2:26 and 8 seconds p.m. 78 California Real Estate Principles 10th edition. 13. 3 joint tenants share interest in a property. If one joint tenant's share is sold using the proper legal formalities, the new owner will then be A joint tenant with the other joint tenants. B. A tenant in common with the other joint tenants. C. A tenant at sufferance. D. A remainderman. 14. Community property is A. All property acquired by a spouse or registered domestic partner. B. All property acquired by the spouse during marriage. C. The only form of ownership during marriage. D. All property acquired by a spouse or registered domestic partner that is not separate property. 15. One of the forms of concurrent ownership is A. Ownership in severalty. B. Tenancy and partnership. C. Sole proprietorship. D. Separate ownership. 16. A partner has A. An absolute right to use partnership property. B. The right to assign partnership property. C. The right to convey partnership property by will. D. The right to possession of partnership property for partnership purposes. 17. Absolute control, as well as absolute liability, belongs to A sole proprietor. B. A corporate shareholder. C. A limited partner. D. A trustee. 18. When doing business in California, a corporation chartered in California is A. A domestic corporation. B. A foreign corporation. C. A real estate investment trust. D. A general partnership. 19. Title to a spouse's marital property can be transferred upon death by use of A. An oral will. B. A tenancy in common. C. A living trust. D. A letter of intent. 20. A limited partner is A. Responsible for partnership activities. B. A general partner in some instances. C. Not liable for partnership debts beyond the amount invested. D. Required to take part in partnership business, property. Learning objectives. When you have completed this unit, you will be able to identify the various estates in land, including freehold estates of ownership and leasehold estates of tenancy. A. Describe the difference between a reversion and a remainder. A. List the ways in which title to real estate may be taken by an individual. A. Distinguish the forms of concurrent ownership. A. Describe the attributes and ways of acquiring community property. A. List the forms of business ownership of real estate. And A. Define a trust and describe how a trust can own real estate. California_E_principles_10E_book.imp 61 the 23rd of May 2017 2:26 and 2 seconds p.m. 62 California Real Estate Principles 10th edition. Key terms: beneficiary commingling, community property with right of survivorship, concurrent ownership, condition subsequent, corporation estate, estates of tenancy, fee simple absolute, fee simple estate, freehold estate, general partnership, inter vivos trust, joint tenancy, leaseholds, life estate, life tenant limited liability company, LLC, limited partnership, living trust measuring life ownership in severalty, partition action, partners, partnership, power of termination, quasi-community property, real estate investment trust, REIT, real estate syndicate, registered domestic partner, remainder reversion, right of survivorship, S corporation, separate property, sole proprietorship, successor trustee, tenancy and common tenancy and partnership, testamentary trust, trustee, unity of possession, vesting of title, estates in land. In the previous unit, you learned that in California the term real property means the same thing as real estate. The terms are used interchangeably to refer to a land, a fixtures to land, a anything incidental or appurtenant to land, and a anything immovable by law. The ownership of property consists of a bundle of rights or interests in it. Rights of ownership include the power to possess, use, exclude others, and dispose of the property. An estate is an interest in property. All property that is not real property is personal property. The rights of land ownership that are covered in this unit are shown in Figure 3.1. Freehold estates. In medieval England, the freehold estate was the highest form of land ownership. The owner of a freehold estate in land could use the property in any way, without being subject to the demands of the overlord. Today's owner of real estate also enjoys a freehold estate, but there usually are some restraints on how the land may be used. A freehold estate can be held for an unlimited time, or the period of ownership may be limited in some way. California_E_principles_10E_book.imp 62 the 23rd of May 2017 2:26 and 2 seconds p.m. Unit 3, Ownership of Real Property 63, Figure 3.1. Estates in land, freehold estates of ownership, life estate, fee simple estate, fee simple absolute, fee simple subject to power of termination, reversion estate in remainder, leasehold estates of tenancy, estate for years, estate from period to period, estate ad will, estate ad sufferance, fee simple estate. The fee simple estate is what may be termed a present possessory interest. It carries the maximum bundle of rights. The owner of a fee simple estate has the right to use the property right now and for an indefinite period in the future. The highest, most complete form of ownership is a fee simple absolute. If the right of possession is restricted in some way, it is a fee simple subject to a power of termination, or fee simple defeasible. A fee simple estate may be granted subject to a limitation on the use of the property or a condition that the property holder must, or must not, perform. The power of termination expires 30 years after the recording of the document creating it, unless it is extended for an additional 30 years by recording notice of the extension before termination of the prior 30-year term. A power of termination will not expire during the lifetime of the grantor, if the grantor is a natural person and the grant was made without consideration to a governmental entity or a tax-exempt organization. With a fee simple estate subject to a condition subsequent, there is some action or activity that the fee simple owner must not perform. If the condition is broken, the former owner can retake possession of the property. Enforcement of a fee simple subject to a power of termination or condition subsequent is by filing a notice of that intention or bringing a civil action. The notice must be given, or action brought, within 5 years of the breach of the restriction or the power of termination will expire. California_E_principles_10E_book.imp 63 the 23rd of May 2017 2:26 and 5 seconds p.m. 64 California Real Estate Principles 10th edition. For example, a rancher gives a 1,000 acre parcel of rural land to the Church Youth Fellowship on the condition that there is no sale or manufacture of alcoholic beverages on the property. Years later, the The rancher visits the property and is surprised to find a reception in progress and a no-host bar at which drinks are being purchased. What can the rancher do? The fellowship has broken the condition subsequent to its fee simple right of ownership. The rancher can file a notice of his intent to re-enter the property and claim possession, or he can bring a legal action against the group. Life estate. The owner of a life estate has the right to possession and use of property, but the estate lasts only as long as the life of a person, or persons, identified in the deed or will that creates the estate. Usually, the measuring life is that of the holder of the life estate. If the right of possession returns to the original property owner when the life estate ends, the original owner has a reversion. If the right of possession goes to a third person when the life estate ends, that person has a remainder. The remainderman holds an estate in remainder during the existence of the life estate and a fee simple estate on termination of the life estate. Fee simple life estate. Fee simple remainder reversion. Or the holder of a life estate, the life tenant, must keep up the property and pay taxes. If the life tenant pays a debt, such as mortgage principal, which also benefits the reversioner or remainderman, the life tenant is entitled to reimbursement. The use of the life estate can be transferred by gift, lease, or sale, but the right to use and possession ends with the measuring life. Because there can be no guarantee that anyone will live to a certain age, the value of a life estate will be based on the life expectancy of the individuals against whose life the estate is measured. A special situation arises when the measuring life is that of someone other than the holder of the life estate. The life tenant may die before the person against whose life the estate is measured dies. In that case, the life tenant's interest passes to that person's heirs and will last until the end of the measuring life. The reversioner or remainderman can give, sell, or lease that interest, but no right of possession will take effect until the termination of the life estate. For example, a widower died, leaving a life estate in his home to his sister and the remainder to his only son. The sister had been living in an apartment and was very pleased to have the use of the house. The son, upset when he found out what his father had done, insisted on being allowed to live in the house, for it was really his. Does the son have that right? Mortgage interest is considered the responsibility of the life tenant. California_E_principles_10E_book.imp 64 the 23rd of May 2017 2:26 and 7 seconds p.m. Unit 3, Ownership of Real Property 65 Number. The deceased sister, the life tenant, has the sole right of use and possession of the property while she lives. Leasehold estates tenants are those who rent or lease property from landlords. Tenants own non-freehold, less than freehold, estates called leaseholds or estates of tenancy. Instead of an ownership interest, the tenant has the right to use the property for the stated period. The length of the lease term determines the type of tenancy. Estates of tenancy are discussed in more detail in Unit 12. Exercise 3.1 Identify each of the following types of ownership interest in land. 1. Dennis has sole possession of Blackacre for as long as he lives. 2. The Middle Falls School has sole possession of Whitaker on the condition that it is used for educational purposes. 3. The town of Merry Meadows has a beautiful library building. The building is a former mansion that was donated to the town with the stipulation that it be used only as a library. What kind of estate does the town have? 4. A renter has lived at 316 Iowa Street for 15 years on a month-to-month lease term. Although his rent has been increased every few years, the landlord has never drawn up a lease agreement. What kind of estate does the renter have in the residence on Iowa Street? 5. In her will, Shaw left her residence in Palm Springs to her nephew, Simon, for the life of Simon's sister, Enette. On Onette's death, the home is to go to Annette's daughter, Yvonne. What estate does Simon have? What estate does Yvonne have? What happens if Simon dies before Annette does? Taking title to real estate. A conveyance of real estate is called a grant. The person conveying the property, the owner, is the grantor. The person receiving the property is the grantee. There will be many possible roles for the owner of real estate discussed throughout this book. A good rule of thumb to remember is a word that ends in or stands for the property owner. Title to real estate, its ownership, can be taken by one person or by more than one person. When a conveyance of real estate is done correctly, title vests in, is transferred to, the grantee. Advising someone on how to take title is a legal action that may have tax and other consequences. Such advice should come from an attorney or CPA, certified public accountant. A real estate licensee is prohibited. 66 California Real Estate Principles 10th edition. From giving legal advice. Individuals taking title to property should indicate their status as a single, never married, a married, a registered domestic partners, a unmarried, divorced, a widows, if the husband has died, or a widower, if the wife has died. For example, title may be conveyed to Sarah Smith, a single woman, or John Jones and Robert Lopez, registered domestic partners. Ownership in severalty. Ownership in severalty, also called separate ownership or sole ownership, is ownership by one person. The property owner, who can be an individual or a legal entity, such as a corporation or trust, is the only person to receive the benefits of ownership. The separate owner also is the only person responsible for the burdens of ownership, such as the payment of taxes. Concurrent ownership. Concurrent ownership is ownership by more than one person at the same time. There are 4 types of concurrent ownership, as shown in Figure 3.2. Tenancy in common. A tenancy in common is created when it is specified by name. It also is created when more than one person takes title. They are not married to each other, and no other method of taking title is specified. Tenants in common may take title at different times and may own equal or unequal shares. If no distribution is specified, tenants in common are presumed to own equal shares. Tenants in common have what is called unity of possession, which means that each tenant has the right to possession of the property and cannot be excluded by the co-tenants. Even if they own unequal shares in the property, each has the right to use all of it. If the property is rented, tenants in common share the rent according to their individual shares. Expenses of the property, such as taxes, also are shared. Tenancy in common is the default form of ownership for 2 or more unmarried people. California_E_principles_10E_book.imp 66 the 23rd of May 2017 2:26 and 8 seconds p.m. Unit 3, Ownership of Real Property 67. Figure 3.2. Concurrent ownership. Tenancy in common. Joint tenancy. Community property. Tenancy and partnership. Parties any number spouses or registered domestic partners any number. Time anytime same time anytime. Title. Separate titles to each interest. Only one title. Interest. Separate, undivided interests. Equal, undivided interests. Equal, undivided interests. Equal, undivided interests. Possession and control of property. Equal right for each owner. Equal right for each owner. Equal right for each owner. Equal right except for personal property. Conveyance. Yes, of each share separately. Yes, but creates tenancy in common as to that share only if both spouses join in the conveyance. Only if all partners join in their conveyance. Deceased's share on death passes by will or intestacy. Passes to surviving joint tenants. Half to surviving spouse. Half by will or intestacy. Can pass to surviving partners. Heirs have right to deceased's share of profits. New owner of partial interest. Tenant in common. Tenant in common. Tenant in common. No community interest. Tenant in common. Creditor. Sale of individual tenants' interest. Sale of individual tenants' interest. Entire property available to satisfy debt. Entire property available to satisfy partnership debt. A tenant in common can give away, sell, or devise, will, her share of the property to someone else. The recipient receives the share of the tenant in common and full right of possession. A tenant in common may want to dissolve the shared ownership. This can be accomplished by agreement of all co-tenants or, if there is a dispute, by a lawsuit known as a partition action. If it is possible to divide the property among the owners in equitable shares, the court will do so. Otherwise, the property will be sold. If a sale is ordered by the court, the proceeds of the sale will be distributed to the co-tenants in the same shares as their ownership interests, less a proportionate part of any expenses owed. For example, L. Sarah, and Joe are all owners of Paradise Acres, a mountain retreat. They own a fee simple estate as tenants in common. Each has a 1/3 share of Paradise Acres. Gibbon Properties manages Paradise Acres. Who pays the management fee? Who gets the profits, if any? Each of the tenants in common is responsible for 1/3 of the management fee. Each will take 1/3 of the profits, if any, after the management fee and expenses are paid. California_E_Principles_10E_book.imp 67 the 23rd of May 2017 2:26 and 8 seconds p.m. 68 California Real Estate Principles 10th edition. Joint tenancy. A joint tenancy is a special form of co-ownership. It requires that all co-owners take title to the property at the same time, by the same document. In addition, each must have an equal share of the property. These 4 unities of a joint tenancy, which can be remembered by the acronym TIP, are as follows. 1. Tar unity of time. Each takes title at the same time. 2. Tar unity of title. Each receives title through the same deed. 3. Unity of interest. Each owns an equal share. 4. Par unity of possession. Each has the right to use all of the property. If the joint tenancy is created properly, the joint tenants benefit from the right of survivorship. This means that when a co-tenant dies, the survivors receive the deceased's share. If there are only 2 joint tenants, when one dies the other becomes sole owner of the property. One of the most important features of a joint tenancy is that, when ownership transfers by right of survivorship, whether to a sole surviving joint tenant or more than one surviving joint tenants, the property does not go through probate. As a result, however, a joint tenant cannot name an heir to his share of the property. As long as the joint tenancy exists, the right of survivorship in the other joint tenants takes precedence. For example, Jessica and Sophie are cousins. 10 years ago they bought a house as joint tenants. Their deed did not include the words "with right of survivorship." Sophie married Trevor and moved out of the house she shared with Jessica. Before Jessica and Sophie could sell the house, as they had agreed, Sophie died unexpectedly. Who owns the house? Jessica is sole owner of the house. Jessica and Sophie had taken title as joint tenants, because one of the characteristics of a joint tenancy in California is their right of survivorship. Those words do not need to be written into the deed transferring title to the joint tenants. Even if Sophie had made a will leaving all of her property to Trevor, the will would be ineffective as to her share of property held in joint tenancy. A joint tenant can terminate a joint tenancy, but the advice of an attorney should be sought to avoid problems. It is also possible for a joint tenant's share to be transferred to someone else while the joint tenant is still alive. Again, legal requirements must be followed. Such a transfer will sever the joint tenancy only as to that tenant. However, the new owner becomes a tenant in common. If there is only one other co-tenant, the joint tenancy has been completely destroyed. If there is more than one co-tenant, the joint tenancy remains in existence as to the other tenants. They still have the right of survivorship with respect to their interests. Any 2 people can be joint tenants, including a married couple and registered domestic partners, discussed in the next section. Because spouses and registered domestic partners also can hold title to real estate as community property, they will want to consider the benefits of each form of ownership, preferably with the advice of an attorney. As pointed out earlier, a licensed real estate agent may not give advice on how to hold title. A joint tenancy requires unity of time, title, interest, and possession. California_E_Principles_10E_book.imp 68 the 23rd of May 2017 2:26 and 8 seconds p.m. Unit 3 Ownership of Real Property 69 Community Property. Community property is real or personal property acquired by a spouse during marriage or by a registered domestic partner as defined in Family Code Section 297. Each also may own separate, non-community, real or personal property. However, and acquire separate property. The rules described below for spouses apply also to registered domestic partners. Property that was a married person's separate property before marriage remains separate property after marriage. Property acquired during marriage may be either the separate property of one spouse or community property belonging to both spouses, depending on its source, the actions of the parties, and legal presumptions. Separate property is property acquired A by gift or inheritance to one spouse, A with the proceeds of other separate property, or A as income from separate property. Most other property acquired during marriage is community property. Spouses are allowed to change community property to separate property by written agreement. The handling of money can change its character as separate property. If there is commingling of separate funds, placed in the same account, with community funds, they lose their status as separate property. If the ownership status of property is unclear, the courts will follow the legal presumption that real property in California acquired during marriage and personal property, wherever it is located, that is acquired during marriage are community property. Community property cannot be sold, mortgaged, or leased for 1 year or longer without the agreement of both spouses. Both must sign all documents. A spouse can convey her interest in community property by will. The inheritor and the surviving spouse would then be tenants in common. If a spouse dies without a will, the surviving spouse is entitled to half of the community property as her own interest and also receives the deceased spouse's half. Community property with right of survivorship. As of July 1, 2001, spouses can take title to property as community property. With right of survivorship, the document of transfer would have to stipulate that form of title, and both spouses would accept title in that form by writing on the face of the document a statement signed or initialed by both. With the right of survivorship, title passes to the surviving spouse without probate, just as if it were held in joint tenancy. Prior to the death of either spouse, the right of survivorship may be terminated in the same way that a joint tenancy may be severed. Civil Code 682.1. For example, Ignacio, a married man, signs a contract to sell the mountain cabin he owns as community property with his spouse, Manuela. Manuela is away on a business trip at the time the contract is drawn up and isn't interested in selling the cabin anyway. Can the buyer enforce the contract? No, because the cabin is community property. Both spouses must sign any instrument of sale. Spouses can agree to change community property to separate property. California_E_principles_10E_book.imp 69 the 23rd of May 2017 2:26 and 8 seconds p.m. 70 California Real Estate Principles 10th edition. The concept of community property is a holdover from Spanish and Mexican rule. Only California and 7 other states still treat marital property in this way, and there are important differences in each state's law. In any move from state to state, the applicable laws should be determined to avoid conflict regarding property status. Quasi-community property. New California residents should be aware of the concept of quasi-community property. Quasi-community property is any California real estate acquired by an out-of-state married person that would have been considered community property if it had been acquired by a resident of California, and any California real estate acquired in exchange for real or personal property located anywhere, when the California real estate would have been considered community property if it had been acquired by a California resident. Tenancy and partnership. The members of a partnership can own property for partnership purposes. A general partnership is established when 2 or more persons carry on a business for profit. As co-owners, property owned by the partnership is owned by their individual partners. As a tenancy and partnership, all partners have the right to possession of partnership property for partnership purposes. Partnership property can be attached only by partnership creditors. When rights to partnership property are assigned, the rights of all partners must be assigned. The death of a partner will dissolve the partnership, unless there was a prior written agreement to continue the business. If a business is dissolved, its assets are sold, creditors are paid, and the remainder is distributed to the partners. If a partner dies and the business continues, that partner's right to possession of partnership property, the business, goes to the surviving partners. The heirs of the deceased partner have no right to the property, although they are entitled to the deceased's share of the profits. The partners may agree in writing to a different distribution. A partner's right in property owned by the partnership cannot be community property. For some purposes, however, a partner's interest in the partnership itself is treated as community property. For tax purposes, all partnership income is distributed to the partners, who report that income individually. An important feature of a partnership is that each partner is liable for partnership debts. For that reason alone, the decision to form a partnership requires careful consideration. For example, George is a partner in Realty Agents, Incorporated. The partnership leases office space in 4 buildings. George needs storage space for some furniture he is giving his son. May he store the furniture in the partnership's office? Number. As a partner, George may not use partnership property for personal purposes. Property 71. Exercise 3.2. What form of ownership does each of the following people have in the property described? 1. Jane and her brother own a farm and have a right of survivorship. 2. Fred and Arleta own their home as spouses. No form of ownership was specified in their deed, as Fred and Arleta have not yet consulted an attorney. 3. Cal and Lou, both single men, bought a 3-story Victorian home in Sacramento. No form of ownership was specified. 4. Helen is a partner in Real Estate Consultants, which owns a shopping center. 5. Fred, a married man, inherited a cattle ranch from his uncle. Fred is the uncle's sole heir. Business ownership of real estate. Other types of business also can acquire, use, and sell real estate. This section discusses the following: a sole proprietorship, a corporation, a general partnership, a limited partnership, a limited liability company, a trust. Sole proprietorship. The sole proprietorship is the simplest form of business ownership, because it has only one owner. The sole proprietor A conducts business in his own name or under a trade name, A reports business income on his individual income tax return, and A is responsible for the business's debts. The sole proprietor may or may not have employees, such as personal assistants. Corporation. Every state has specific laws regulating the formation, operation, and dissolution of corporations. The owners of a corporation are called shareholders. California_E_Principles_10E_book.imp 71 the 23rd of May 2017 2:26 and 8 seconds p.m. 72 California Real Estate Principles 10th edition. The corporation is a separate, legally recognized entity, apart from owners, shareholders. A must be chartered by a state. A acts through its board of directors and officers. A may own, lease, and convey real property, and A limits liability of officers, directors, and shareholders. A corporation could be formed for a non-profit motive. A non-profit corporation is owned by members rather than shareholders. It can own, lease, and convey real estate. Corporations are called domestic corporations by the state in which they are chartered. Created. Corporations created in any other location are called foreign corporations. In California, for instance, corporations chartered by any other state are considered foreign corporations in their dealings in California. Liability. A major benefit of doing business as a corporation is that individual officers, directors, and shareholders are usually not held personally accountable for corporate decisions and corporate debts. Increasingly, legislation such as the Federal Sarbanes-Oxley Act of 2002, also known as the Public Company Accounting Reform and Investor Protection Act of 2002, has imposed a greater level of accountability on officers and directors of public companies. Corporation. One disadvantage of a corporation is that profits are taxed twice. The corporation pays taxes on income, and income is taxed again when it is distributed to shareholders in the form of dividends. Federal tax law provides an alternative method of taxation to corporations with 100 or fewer shareholders. If the corporation is formed under the requirements or subchapter S of the Internal Revenue Code, income is allowed to flow directly to shareholders, avoiding double taxation. In an S corporation, all shareholders must be individuals rather than other corporations. To be treated as an S corporation, shareholders must file Form 2553 with the IRS. If they do nothing, they will be taxed as a C corporation, under subchapter C, and be subject to the double taxation mentioned above. To qualify as an S corporation, the corporation must be a domestic, U.S., corporation with only one class of stock and no more than 100 shareholders, all of whom consent in writing to filing as an S corporation. The shareholders of an S corporation can be individuals, estates, exempt organizations, or certain trusts, but cannot be non-resident aliens. For complete information about filing as an S corporation, consult your tax advisor and the instructions for Form 2553 that can be found at the website of their Internal Revenue Service, www.irs.gov. www.irs.gov. California_E_principles_10E_book.imp 72 the 23rd of May 2017 2:26 and 8 seconds p.m. Unit 3, Ownership of Real Property 73, Partnership. A partnership is an association of two or more persons to carry on a business as co-owners for profit. In a general partnership, each of the partners by definition has authority to act on behalf of the partnership, and each is liable for the debts of the partnership. Limited partnership. To avoid the unlimited liability of being a general partner, an investor can take part in a limited partnership. A limited partnership can be created only in compliance with state law. In California, this includes filing certain information with the Secretary of State. The California Limited Partnership must have one or more general partners who run the business and have unlimited liability for partnership obligations. Other investors can join as limited partners, and their liability will be no more than the amount they have invested in the partnership. By law, limited partners can take no part in the management of the partnership. If they do so, they will be considered general partners and will lose their limited liability. Real Estate Syndicate. A real estate syndicate can take the form of REIT, corporation, general partnership, or other entity, but is usually formed as a limited partnership. In California, real estate syndicates are popular methods of investment for both corporations and individuals. A syndicate of 100 or more participants must be approved by the Department of Business Oversight before syndicate interests may be offered for sale. Strict rules and regulations must be followed. Limited liability company. Almost all states permit property ownership by a limited liability company, LLC. Although each state's law is unique, an LLC typically provides the single-level tax benefit of a partnership with a flexible organizational structure. In California, an LLC is created by filing a one-page form with the Secretary of State. LLC members are not required to have a written operating agreement setting out their rights and responsibilities, although one is advisable. LLC members may adopt corporate formalities, such as resolutions and annual meetings, but are not required to do so. Unlike an S corporation, an LLC places no restriction on the number of shareholders who take part and who they are. The LLC provides something closer to the limited liability for corporate shareholders than the greater protection afforded to limited partners. Unlike limited partners, however, members of an LLC can take part in the running of the organization without incurring personal liability for business obligations. This freedom from liability does have a cost. In California, an LLC incurs higher taxes and fees than either a general or limited partnership. Taxes and fees are higher for an LLC than for a partnership. California_E_principles_10E_book.imp 73 the 23rd of May 2017 2:26 and 8 seconds p.m. 74 California Real Estate Principles 10th edition. Information available on the web. The Secretary of State Business Service Center website at www.sos.car.gov/business/ provides information on corporations, limited liability companies, limited liability partnerships, general partnerships, and other entities, including lists of officers and directors. Trust. A trust can be a form of property ownership. Title to property is conveyed by the trustor, the property owner, to the trustee. Title is held by the trustee on behalf of a beneficiary, who controls the property held in trust. The trustee's powers generally are defined by the document establishing the trust. If the trustee fails to define the trustee's powers, the law of the state in which the trust is created is followed. A trust can last for a short or relatively long time, depending on the trustee's intent. Trusts often are created by the terms of a will, a testamentary trust, to care for the deceased's children until they reach adulthood. Real Estate Investment Trust. The Real Estate Investment Trust, REIT, holds various forms of real estate or mortgages for the benefit of investors who own shares of the trust. REIT shares may be publicly traded. More information about REITs can be found in the following box. REITs in California. A real estate investment trust, REIT, A, is regulated by the Commissioner of Corporations. A, must comply with federal and state tax law. A, must be owned by at least 100 different investors. A, cannot have any 5 investors own more than 50% of the trust. A, must receive at least 95% of its income from investments, and A, must receive at least 75% of its investment income from real estate. The National Association of Real Estate Investment Trusts, NAREIT, serves REIT owners, managers, and related companies. Information on various forms of REITs can be found at the association's website, www.nareit.com. Living Trust. The Living Trust, or Inter vivos Trust, is an increasingly popular form of property ownership. A living trust can be used to hold title to property during the lifetime of the trustor, who is also named as the trustee of the trust. When the trustor dies or becomes incapacitated, control of the property held in trust passes to a successor trustee named in the trust document. In this way, property can be transferred without going through an expensive probate process. A living trust also can be created by a married couple, with the property held in trust going to the successor trustee on the death of the second spouse. www.sos.car.gov/business/ Using a trust to hold title is a way to keep the true owner's identity hidden. www.nareit.com California_E_principles_10E_book.imp74 the 23rd of May 2017 2:26 and 8 seconds p.m. Unit 3, Ownership of Real Property 75, properly drafted. A living trust can be an effective estate planning tool that provides the easiest and quickest way to transfer property at death. Exercise 3.3 What form of ownership does each example below illustrate? 1. The spice company owns a processing plant and leases dock space for its shipments. The company is doing very well, and it paid an excellent dividend to shareholders last year. 2. Joseph Marine owns Worldwide Real Estate. Joseph, a licensed real estate broker, is the only owner of Worldwide and reports company income on his personal tax return. 3. Mountain Properties is a real estate syndicate of 127 investors. Only 5 members of the syndicate are allowed to participate in investment decisions. 4. When Grandpa Moneybags died, he left his farm to his grandson, but his grandson will not receive title to the farm until he is 25. In the meantime, Cattleman's Bank will manage and hold title to the property.